In this video, I'm going to answer the question, what is a bond specifically? What is a bond, how to choose bonds to invest in, and finally, I'll go over some specific ways you can invest in bonds for your own portfolio. There'll be zero jargon or other fancy financial language in this video, so it's a perfect explanation for anyone who's totally new to the whole money and investing world. So if that sounds good to you, give the video a thumbs up and let's dive right in. First off, what is a bond? Well, a bond is just a loan that you give to someone in exchange for interest. And at the end of the loan, you usually get your principal back. All of us are already familiar with bonds because if you've ever lent money to a friend or family member, then you've effectively given them a bond. In the financial world, bonds are actually a legal contract between the lender and the borrower. In many cases, if the borrower doesn't pay you back, you're legally allowed to seize their assets and sell them off so that you can get your money back. That's why bonds are considered to be generally safer investments than stocks. Because unlike with bonds, when you buy a stock, you're actually not legally entitled to anything. Stock investors will only make money if the company makes money. And if there's no profit in the company, then stock investors, they don't get anything. Worse yet, if the company goes out of business, stock owners don't have any legal recourse, which means if a company goes bankrupt, the bondholders may be able to get some of their money back by selling off the company's assets. Stockholders, on the other hand, are generally left losing their entire investment. Now, of course, on the other hand, if the company is successful, stock investors get all of the upside. And if a company goes to the moon and becomes enormously successful, stockholders may get ridiculously rich, while on the other hand, the bond investor will simply just get their interest and their principal payments. Nothing more, nothing less. This means that in general, stocks can provide you a higher rate of return, but that return comes with a risk. Bonds, on the other hand, generally produce a lower return, but are generally deemed to be very safe. That is why stocks tend to be the preferred method to grow your financial portfolio, while bonds help reduce the risk and help preserve your wealth. Stocks can sometimes fluctuate in price wildly, depending on how the economy is doing. For this reason, many people, as they get older, tend to diversify their portfolio away from stocks and into bonds to preserve their net worth. After all, there's nothing worse than finally thinking you're able to retire, only to have the stock market suddenly crash and lose 30, 40, maybe even 50% of your total net worth. Generally speaking, bonds are issued by two primary different groups. Either as a government agency, such as the federal government or state and local governments, and by individual companies. And the two primary factors in determining which type of bonds you should invest in are the overall credit worthiness and the bond yield. Just like you have a credit score, governments and corporations also have a credit score of sorts as well. These ratings are assigned by third-party groups such as Moody's, Standard & Poor's, or Fitch Ratings. Now, a rating of AAA rating is the highest credit rating that a bond issuer can have, which means that their chance of defaulting is extremely low. From there, we have other ratings such as AA all the way down through D, which is the lowest rating possible. A rating of D signals that the company is already in default. Investment ratings of BBB and higher are considered investment-grade bonds, while BB ratings and lower are called high-yield bonds. But don't get too excited at the idea of a high-yield bond, because those bonds are also known by another name, which is junk bonds, aptly named because of the very high risk that is associated with them. Generally speaking, government bonds tend to have a higher credit rating than do many corporate bonds. This is because the risk of agencies like the U.S. government going bankrupt and not repaying its debt is relatively small, while companies face a higher risk. The other important factor when it comes to bonds is the yield, and the yield is essentially how much money you stand to make by owning this bond. For example, if a bond has a yield of 3%, then for every $100 that you would invest in the bond, you stand to make $3 annually. This yield is often correlated to the agency's creditworthiness. AAA investment bonds tend to have very low yields because they're also the safest, while lower tier bonds or junk bonds usually have much higher yields because the associated risk factor is also much higher. This obviously leads to a balancing factor. How safe do you want your money to be, and how much of a yield do you need? One important factor to consider is that many bonds issued by the government are generally tax-free income. So while the yield on those government bonds may be relatively low, you usually won't have to pay a single dime in taxes from the interest that those bonds generate. This can be rather nice, especially for people that make a lot of money and are in a very high tax bracket. One last type of bond that is issued by the government are known as TIPS, or Treasury Inflated Protected Securities. In short, these types of bonds help to safeguard against high inflation rates by paying not only a small yield, but the principal balance itself gets adjusted, usually twice a year based on the current inflation rate. And this means that in general, your money will always keep up with inflation while also returning a small yield. So where can you buy bonds? Well, generally you can buy bonds at whatever brokerage firm you buy stocks at, such as Fidelity, Charles Schwab, or Vanguard. If you want to buy bonds, you can either buy individual bonds or you can buy a basket of bonds. Essentially a group of hundreds or thousands of different bonds that are all rolled into one nice, neat package. So by buying shares in this basket of bonds, you are in effect buying small portions of bonds from hundreds of different companies. This is similar to index fund investing in the stock market. And by doing this, you're helping to diversify yourself as a way to help lower your overall risk. Because if you owned just one bond from one individual company and that company suddenly went bankrupt, you could theoretically lose all of your money. However, if you owned a basket of bonds and that basket contained 1,000 different bonds inside of it, if one of those companies goes bankrupt, it won't hurt your portfolio very much because chances are the other 999 companies will still be profitable. If you want a basket of funds issued by the federal government, you might look for ticker symbol IEF. This fund typically tracks the 7 to 10 year Treasury bonds issued by the federal government, and currently it has a yield of roughly 0.84%. Meanwhile, if corporate bonds are more your style, ticker symbol SCHI is a popular basket of corporate 5 to 10 year bonds, currently offering about a 2.13% yield. So there you have it, guys. Bond investing made easy. While you won't ever get rich investing in bonds, they can be a fantastic way to provide stability to your investing portfolio and to protect your net worth as you inch closer and closer to your retirement years. If you enjoyed this video, be sure to smash the like button and leave a comment down below. And as always, I'll see you all again next time. Thanks.